Hello, this is Jason Wink, and thank you for checking out today's market update video. Today is Monday, November 11, Veterans Day. It's about 4:30 p.m., so the market's closed just about a half hour ago. And first, before I get started, I just want to say thank you. If we have, I know I have clients and friends who are veterans, family members as well, and just want to make sure I say thank you for your service. It's great that we have the privilege to live in a country with a lot of freedoms, and I certainly don't want to take those for granted. In today's market update video, I'm just going to be revisiting a chart that I've shown for many years now. It's funny whenever I pull this up, I kind of think back and try to remember the first time I used an S&P 500 daily chart, and also some of the basic patterns that I've been talking about. And it's literally been over 2 years since I did the very first update, and there's probably been, I would guess, awfully close to 100 of them since then. So this should be familiar if you are a long-time blog subscriber or client. You've likely seen this quite a few times. If you're just visiting for the first time and checking this out, what we see here is the last 1 year of the S&P 500. Each bar on the chart represents a trading day. When we see kind of a white colored bar, that means the day finished up, and a red colored bar means the day finished down. I use a program from StockCharts.com to produce these, and StockCharts just made a little visual update to their chart. So this looks a little fresher and a little easier to see. One of the nice things they've added is at the bottom, this is the volume of the S&P 500, and they've now colored in the volume bars. So it's a green bar representing the up days, and a red bar is the down days. So that's kind of nice. And then there's just a couple other minor kind of graphic updates, even to the way the candlesticks. That's what each one of these, what this chart type is called. Each line is like a candlestick. So without further explanation of what we are looking at, I'm going to show you what it all means. So the blue channel that you see on the left side of the chart, that's the market trend we were in from late 2012, and it lasted all the way up until May of 2013. It broke out of that nice tight upward channel shortly after the Fed chairman, Ben Bernanke, announced that the Fed would start tapering off their bond buying. Now, the Fed hasn't actually started that yet, so while the market sort of corrected, didn't like that news a whole lot, once they realized that the Fed wasn't actually going to start, in fact, they haven't started this year and may not start until who knows when, in 2014, the market's found its bottom and then has since started a new channel, which is the red parallel lines we see here. The long blue horizontal line, that's the long-term support of the market. So if we were looking at this maybe over 2 or 3 years, we'll find that if the market was to have a fall where it came out of the upward channel, that's where I think it would potentially go down to. And we can see, for example, when it broke out of the blue channel, it fell. There's a little line you can see almost touching that blue line. That was the intraday low where it just about hit that long-term support and bounced off it before forming this new channel we're in. Now, this channel that we're in is a little bit different than the last one. The two most noticeable things we can see is that the strength of this uptrend is not quite as strong as the strength of the one before. So, in other words, the basic slope of the trend is still up, but it's not up to the same degree. The other thing that we notice right away is that the range of returns in this trend is wider. So it was a very tight trading range. In other words, it was a fantastic bull market that lasted about 6 or 7 months. In the market, even when it did have its little sell-offs, the sell-offs were really slight, just a couple of percent. In this larger range that we're in now, between the tops and the bottoms, of course, it's going to be a little bit bigger, maybe more like 3.5 or 4%. So when things have gone down, it's gone down more than obviously they did in the past. If we look at where we are today, we're awfully close to the top end of this trading range. And it's, there's really quite a few things that can happen, but the most likely is that the market will consolidate, which means it'll go down maybe to the lower end of this range, in which case the market could potentially drop 4 or 5%. Or it could do the same thing it did to get into this new range, which is it could break out of the range. And that breakout could either happen to the downside or the upside. Now, since we're close to the top end of this range right now, the two most likely things are either a breakout, which means we'd start a whole new uptrend that's outside of this channel. I tend to think that's fairly unlikely, but it's possible. Or we could continue to trade in this range. If it trades in this range, we would see again a modest decline before hitting some support levels and then perhaps coming back up. And we'll stay in this range until there's a breakout, and that breakout has to occur either to the upside or the downside. We know that even when markets get into these channels, those channels don't last forever. If we're able to get 6 or 7 months out of them, that would be considered a very long trend, at least intermediate trend, in the stock market. So when we think about the stock market right now, there's a lot of things that are very positive. I mean, we just today the stock market hit another all-time high, so it's been doing that quite a few times this year. So that's a positive. The general trend has been supported with slightly higher volume. So if we look down at this volume, we can see that for a long time, the volume was actually slowly declining. And while this doesn't look like a big decline, these bars are in billions, so billions of shares. So when we look at like ranges back in like March and February, the average volume was 2.7, 2.8 billion shares traded. As we got later in the year, August, September, those ranges were all the way down to around 2 billion. So, a good 25 or 30% drop in volume. That has since started to slowly pick back up. So now we're back in the maybe 2.25 billion shares traded range. And when markets move in a direction and they're able to be supported by larger volume, it just means that larger investors are also influencing the price moves. When we see the volume really low, we know that most professional traders and institutions are not the ones driving the price up, and so it can be a bit of a trap. Oftentimes, that's the smallest investors who are the last to get in on a rally, and then the big investors come in, sell off their shares, lock in their profits, start a new downtrend, and at the very bottom, the last people to sell are the smaller individual investors. So it's a good thing to see the increase in volume. Some of the things that are not maybe so good is that the relative strength. So if we look at the top, this measures relative strength in the market, and we can kind of see that the peak in relative strength, at least in the near term, was back in mid-September. And since then, the market fell. It went up to another new high that wasn't quite as high as the previous, and is now looking like it may be trending down some. What we like to see is higher highs and lower lows. When that happens, we know that the strength is really there. If this ends up falling and we start seeing a pattern in the relative strength of the highs being lower than the previous high, the lows being lower than the previous low, oftentimes that's a sign that a sell-off or a correction is coming. So what do we mean when we put all this together? Well, I can tell you right now, nothing really means a whole lot. There's nothing that's definitive, which means that the best thing to do at this very juncture is just to continue what you've been doing. It's not necessarily a great time to add to new stock positions, nor is it a time we have to panic and sell off from stock positions. Now, if we look at one other chart, I just want to kind of bring up the bond market, because the bond market has been a lot more tumultuous this year than has the stock market. So this particular chart we're looking at, this is the aggregate bond index as measured by one of the largest bond ETFs, the iShares Barclays Aggregate Bond ETF, symbol AGG. This is a weekly chart, so it's looking at the last 5 years. And the reason this is kind of, I think, actually not kind of, I think it's very important, is that for a very long time, in fact, much more than 5 years, the bond market was in a nice steady uptrend. There weren't a whole lot of large-scale corrections. You can see I drew in this blue line showing that uptrend that it was in for quite a while, which broke in May of this year. And from that peak all the way to its lowest point, bonds sold off about 5%. Now, bonds have come up a little bit from their lowest point. So the lowest point this year would have been around late August, early September. And since then, we've seen bonds come up a little bit. But in the last 3 weeks now, for 3 consecutive weeks, the bond market has sold off. It's gone down a little bit, gave back about another 1 to 1.5%. And this is including the interest that bonds are paying. So this is the net return of both the price change and assuming that interest or interest payments are reinvested. So we can still see that for the year, bonds are down about 4%. This, of course, is very frustrating if you're a fixed income investor, someone who's very conservative and has a lot more bonds in your portfolio than stocks. This will be a pattern we'll have to keep a close eye on, because what we're seeing is perhaps a change of the guards. We never want to get panicky and make really quick knee-jerk reactions, but what we can see is that clearly from the high, it almost looks like a new downtrend could be coming that perhaps could last quite a while and bring prices down substantially. It's a little too early to confirm that, because we have not seen a retest of the lows. But if, again, If this most recent peak 3 weeks ago ends up being the high, and then the market goes down and sets a new low, that would form sort of a channel in the opposite direction we'd like to see. It would certainly be a warning that bonds, at least for perhaps a few months to even a few years, are definitely a bad place to be in. We'll have to start looking at a lot of alternative defensive ways to be a conservative investor. So for now, much like the stock market, there's nothing conclusive, just that we're cautious and we're watching and waiting to see what happens. The good news is while we're in that wait and see pattern, it's not like we're waiting for a 20 or 30 or 40% drop or anything. The bond market does move pretty slow, so 2 to 5% changes are kind of the norm. And if we do fall into a new low point, that's only about 2.5% farther than where we are today. So it's not like we're waiting, and while we're waiting, we're losing, hand over fist, but it is the responsible and patient thing to do. At some point, bonds will find a bottom. And when they do, interest rates are likely to be quite a bit higher, and that'll be a great entry point for investors. But again, like the stock market, now is not necessarily the time to sell, nor is it the time to buy. If someone has a conservative or a balanced portfolio, the best medicine in the, probably between now and the end of the year anyway, is to continue to hold on to that type of portfolio and wait until the new signs emerge. So hopefully this has been helpful. It's been a little while since I've been able to do a market update video. It's been rather busy in the Wink family. Some of you know my son is involved in youth football, and our youth football season somewhat unfortunately and somewhat fortunately came to an end just on Saturday. So my schedule for the first time in about 4 months will finally be a lot more open than it has been. So thanks for checking out this video. I'm sure I'll be doing a lot more posts between now and the end of the year. If you have any questions or comments, feel welcome to use the comment feature on my blog, or you're always welcome to send an email directly if you have my email address. Thanks again, and have a great rest of the week.